Happy Thursday for anyone that I haven't seen in the left circle right before this. The idea behind this talk or this discussion really is I think there were like two events in a row where this kept coming up is how do we think about financing smaller renewable projects, right? And Barrett, you did an amazing or gave an amazing talk really on solar in Africa and your experience and the timeline and how things have shifted. And then out of that, and again, another talk was this idea that, emerging market US or just like smaller projects in the US are actually very similar to emerging market outside of the US. And so how do we take some of those learnings, apply it here? I This is an unusual member led event in the sense that like I'm kind of the member leading it, but it's actually just a consortium of members who are all here. And so I think the way that I'm going to do it, and we'll do it live and, speak up, say if you want it to go in a different direction. It's really, again, it's a discussion. But the three sort of big level questions that I had on my own side were, I think, it's a question of financial innovation is my understanding around this space. And so what financial innovations have worked to be able to get small renewable energy projects developed in the US, what haven't? And then there's been this idea floating about grouping together smaller renewable projects so that they can be financed by project developers that want bigger projects. Has that been done? If not, why? And so that's my context for how this event came about. I'm going to do like very rapid fire for anyone on camera and or anyone that like raises their hand to just ask you why you're here and what you're interested in, what you want to contribute. Great answers are, I'm here to listen. I started a company in the space. I, have deep expertise in the space, or I'm just curious, right? Any of those things, but I just want to get a rapid fire. So Tim, let's start with you. And again, like 5-second answer, actually rapid fire.
I work for giant investment firms, so I have some perspective on how they think about this stuff that maybe I could share.
Amazing, cool. And then Tim W.
Just working in the kind of climate startup ecosystem. So always thinking about how we connect some of our startups into getting, if they're project-based, getting project funding, et cetera.
Cool. Kevin?
Finding the mute button. Hi everyone. Started a company called Bright Saver. It's a nonprofit focused on micro solar or balcony solar. So I'm here to learn and contribute what we've learned so far.
Cool. Peter?
I have a potential client who is interested in sourcing renewable energy in emerging markets, and I was curious how projects that are subscale might fit into that kind of product or that market fit.
CJ?
Yeah, I'm working across a number of things in the startup ecosystem, including the battery space, as well as with some kind of project finance standardization opportunities to make smaller systems more accessible to mainstream financial institutions. So just curious to connect some dots.
Yeah, cool. Barrett, wait, SC, and then Adam. But again, rapid fire. So Barrett?
Yeah, I mean, I've had a lot of experience thinking about how do we finance people that don't have a great credit score. And
Great.
so the challenges around that.
Yeah. Way.
Oh, I'm just curious and want to learn more.
Cool. SC and then Adam.
Yeah, I basically worked in solar about 6 years ago in the UK and then Netherlands and Switzerland, and then really wanted to get back to my roots after being in EV charging and direct air capture. And now listening in, trying to understand where the challenges lie, and possibly looking at problem spaces as well to put together my own business.
Cool. And then Adam.
Electrical engineer focused in power. Worked on the DOE WMSI FOA for wholesale electric market reform, and then have connected 6,000 plus families for first-time electrification.
Okay, so very diverse group in terms of background expertise and desire to be here. What if we started it with and again, this is like actually an open discussion, and so we'll take it wherever it makes sense to go. But I'm going to start with a clarifying question on my side, which is the problem here? We group the problems as there's a problem of people with an issue, a low credit score, right? Like Barrett, what you just said. And then my understanding too is that there's a problem with smaller projects being attractive to project developers because it basically takes the same amount of money to due diligence on a small project as it does on a bigger project, but a bigger project will give back, more money over time. So that's my understanding of the second problem. Am I misunderstanding either of those? And are there third and fourth problems that we should, put on the table?
I think there's some challenging solutions that have their own problems within the solution, but that sounds like the problem.
Yeah, let's get into those because I like talking about what doesn't work. I think that really helps. Are there any other problems that people see? Yeah, Tim.
Well, I was just going to talk about one of the characteristics of the market for green infrastructure right now is a lot of capital in a few giant mega funds that are driving tons of the investment, and the largest possible projects fit best for them, both because they have to put a ton of capital to work, and you talked about the economies of scale issue that drives the economics of the biggest projects. But they're not going to be the only investors. There are going to be smaller infrastructure funds to follow that are trying to exist now. And there will be people who aren't infrastructure funds. Local banks can be a great source of this kind of stuff, who have a little bit of a dual mandate. So, when an investor is looking at one of these projects, fit for the investor is the biggest driving factor, even above and beyond, hey, how good is this team? How good is this idea? It's got to fit for them, or the answers to those questions, what you think of as the first two questions when you go into investors don't matter if the project doesn't fit. So finding the sources that fit, and the sources that fit giant projects just have tons more money and have raised much more money over the last couple of years than anything smaller. But there will be investors who can find a smaller project attractive, particularly if you can get paid a little bit more by the utility, or get helped out a little bit by local municipality help that could help drive it. So I think thinking beyond the absolute biggest infrastructure funds is a very helpful thing.
So, okay, wait. So there's something there about like blended finance that I think you brought in that might be one of the solutions, Bear, that you're like yes, or like big problems, right? Like, I want to dig into that. Pete, you said FX risk. What's FX? Finance risk?
Foreign exchange, I think one of the interesting problems that I look at with some of our customers is all these opportunities to do decarbonization in multinational companies and typically in their local operations. And one of the complexities with doing that is hedging FX risk, particularly around returns on things that are relatively low return, things like efficiency in solar and so on.
Yeah. Is that the same as CJ, what you said, international cost of capital, or would you put that in a different bucket?
No, I think just the perceived risk on international projects has driven up. I read something a while ago from an RMI report that was like cost of capital and microgrids in it, like electrification in Africa is close to 50% of project costs. This is many years ago. I dealt with some stuff in the Middle East, seeing the same thing. Like when we were doing with like 4% cost of capital, it was 25% there. So yeah, I think just the investor perceived risk on international.
That doesn't count for US smaller projects, right?
I mean, it's just, I'm bringing that up as a totally separate issue. I think kind of the international domestic are
Yeah.
pretty different beasts that probably merit different approaches.
Yeah. Okay, so I think for the sake of this conversation, let's stick with US, just because of what you said, CJ, where it's like potentially hugely different issues. And so would that mean, Pete, your financial exchange risk is also not applied to US, or does it apply to US?
No, it would not in this
Okay.
case.
Okay. Um,
I do think there's probably an underlying issue that does relate, which is perceived risk
yeah.
that kind of crosses across. Yes, it takes on a almost absurd form in the international development space. But, like when you look at Resi Solar in America, I think the lowest lending programs never have gotten below somewhere in the 600s for FICO. And so if you just kind of use that as a mechanism for determining who can get residential solar, it's pretty far from need and economic burden.
Okay. So bad credit, just like the economies of scale, not wanting to finance smaller projects when you have bigger projects on the table, and then perceived risk. Does that feel like the right three categories? Cool.
Maybe user applications, like that would work for in general this type of population that rents or lives in low-income housing.
Mhm.
I don't know.
So are you saying because they rent, they can only
Well, like that, just like, for example, I think Cora I was just talking to, she's looking at balcony solar or, just certain ways beyond the money flows and the perceived risk. Like, is there a real value? Is there a proposition
That's
side
interesting.
that could work for this segment of the market? For example, like Aaliyah from Allume Energy
Yeah.
doing multi-dwelling home installations.
Yeah.
Yeah.
There isn't a note stock. This is my notes. So maybe we should actually create one. If anyone else wants to volunteer to do that, I'm open to that. And I can take it over in a second because I do want to actually have other people sort of lead this, but I'm just going to leave this like opening until discussion hopefully takes off in a way. But so we've got these four things: bad credit, economies of scale, perceived risk, value prop for some like low income sorts of folks, and like what are they actually getting? Is it valuable to them? And then I feel like, Barrett, do you want to just go into like what hasn't worked? And then that can open up, right? Floodgates of like what hasn't worked, and maybe what has worked. And then I'm gonna take a step back and you guys just, jump in with where you want the flow of the conversation to go.
Yeah. Um, sure, yeah, let's just start what do I've seen not work. Um, and then we can just pass it around and see everyone's experience. And I will say, just as a preface, I have spent a large part of my time thinking about the international iteration, and so my lens for domestic work has largely come through Native American reservations, which is the only domestic environment that my organization has worked in. But I will say some things I infer because our donor is or our primary donor and board chair is behind a company called GoodLeap, which is the largest financier of residential solar in America. And so they have a pretty good data set on the residential market, which I'll reference, although that's not my direct line of work. And so what I'll say is in the two categories I've seen, it's like on one level, when you do financing, your product ultimately is something that some equity fund above you wants to buy. And so you're competing in a market where this large group of investors has lots of options for what they want to do with their capital. And you've got to find something that's competitive. And for a long time, solar relied on the tax credit to be competitive in capital markets, like the tax equity flip that allowed the owner of the systems on people's roofs to claim the tax credit. And that enabled a lot of corporate capital to come into the market because it wanted those tax credits because it was essentially like return on day one when you had a huge tax burden. The downside of that is that it's created this situation where in that competitive space, there's not a lot of downward pressure on credit scores and risk assessment because instead of that, everyone's trying to fight for the most secure, most high return market segment because that's the easiest to sell on to existing funds. What I've seen work at the fringes of that is some kind of blended capital stack where you bring in grant financing to either securitize the loan or make the lender more willing to do it in a variety of ways. In the Native American country, we are seeing some pretty good work around that now, but it's been a perilous path because the grant capital is not scalable. right? And it also requires a more sophisticated structure than a normal deal, which to some degree carries cost and often cannot be structured by the entities bringing in the grants, right? And so you have this kind of capacity shift where you have financial entities that need to be motivated, but then the grant capital has to run through mostly small and more grassroots organizations to then partner with these large financial firms that, of course, are going to negotiate very good deals for themselves.
Mm.
And so um, I think there's been a real challenge in figuring out any financial vehicle that serves, non-primary solar markets. I think in the last year and a half, we've seen that get really exacerbated by interest rates and what's happened in residential solar financing broadly, where it's been a bit of a bloodbath for everybody. The roller coaster has contracted again, and so yeah, so I don't know exactly how we reconcile now even the diminished appetite of commercial capital to flow into this asset class, uh, then coupled with where we're going to get the grant funding to even stay competitive at current rates. And so that would be kind of where I see it, and some of the kind of long-term trends that are, kind of pinching against each other and pulling in opposite directions at this moment in the market's development.
Fascinating. Okay, so brought up the issues with tax credit as like one solution, and then also grant funding as a second solution, where in either case it can get complicated. In either case, it's sort of cyclical, right? Where it's like really hot and then it's not as hot. Is that another thing that you're saying?
Solar has always been a bit of a roller coaster, right? Like I think anyone that's been in solar in America for more than 10 years has seen it buck a few times now. And so I'd just say, 2020 was one of the most gangbuster years we've had in solar in recent history, and 2021 was quite good. But then since then, we've been coming off that high as an industry with reduced volumes and increased financing costs. And so volumes broadly are down, and then certain states are almost not commercially viable, or at least not very competitive with the current rollbacks on the utility side and increases in financing costs.
Cool. Anyone else want to go down Downer Street, which is just Reality Street, I think, what hasn't really worked so far? And yeah, anyone else?
I'll add that we still have a significant backlog in the interconnection queue, and while FERC has done some great stuff to put that in, the actual legal battles to implement all that stuff are ongoing. And while I don't see the current administration like messing with that super hard, because it was a FERC initiative on the greater hand of it. I think it's more everything else that's going on that will just kind of extend the complications of getting that in place, for all the different recent orders that are going on. But that being said, the amount of stuff that's in there, even if you consider all the junk stuff that's in there for cost estimations and considering the real capacity versus the actual working capacity, once everything's installed, pretty much all of the actual generation, not including storage, will basically wipe out all of our methane generation. So once it's in there, it's going to be huge. It's just actually getting it on board is the biggest part. But it also has to be said that a lot of those are not financed yet. They're just kind of project ideas too.
Kevin, did you have something to add?
I have more of a question about kind of, I think it might be helpful to break things down into kind of different categories. So Barry covered, grant financing and, oh gosh, what was the other one? ITC. And so I'm kind of more curious about debt financing, for projects and kind of understanding for small projects, what kind of scale, what kind of track, how much data points are necessary for some of the small scale debt financiers. I don't know if anybody has any experience with that. the other area I'd be curious about is it's maybe not financing so much as revenues, but it's renewable energy credits, and if anybody has any experience with RECs.
Can I hop in real quick? And I'm gonna have to drop at the half hour, so sorry for that. Just had a shift come up. Um, so two things about debt financing. The more that you go towards standardization of the product, the more you can reduce the financing cost per unit. And so residential solar in America has had a hard time because we actually have a pretty big range of solar costs all considered. Interconnect really changes. Like if you look at fully loaded solar in America, you can't look at like Utah and California and just have a uniform price per unit. It doesn't translate very well. Whereas if you look at, I'm sorry to draw on the development context, the small home system guys, like people that make a product that has an inbuilt financing to it. So they're like, giving you a solar lantern that's, standard, that those guys then can bring per unit financing costs down a lot and serve much, much lower end customers because so many deals are broken by the financing cost. And so one thing I found difficult is that the American consumers tend to have highly different footprints and we want like a customized solution, but then that makes it really hard to serve especially lower end customers. And then the
Barry, just to double click on that, just a quick question there.
yeah,
Do you
please.
mean that some of these micro, solar equipment companies, they themselves are able to get debt financing, or are you talking about the ability for them to provide debt financing to their customers?
They're able to make a structured financing product that they can sell that then allows them to provide financing to the customers. So
Yeah.
most of the time they're still providing the kind of origination function, but it's easier to get African Frontier Capital to buy $500 million of exactly the same solar loan against a bunch of Africans than like 1,500 different Navajo houses with off-grid systems that have totally different specs and panel sizes and energy bills that they're offsetting. So even the revenue side looks different. And so that's much harder. Right? It's just much harder. And, these are low-end customers. So the Navajo house still is, half of the average American residential house. Right. And so yeah, so I just think there's a little bit of a balance there where uniformity has really been a challenge and and I think I mentioned it briefly, but I'll say it's just kind of the final point that I have is that um, I think that there's a variety of deals that just can't get across the line because of financing cost. I see it all the time in infrastructure development in many places where, based on, trying to use the wrong, less patient capital to build the product becomes too expensive and the savings proposition breaks down. And since solar is so highly contingent on being cheaper than your energy source, it doesn't take massive swings in financing cost to reduce the proposition of solar. And it tends to be heavily financed, even worse, right? Like you have people that are putting $500, $1,500 down against $20,000 systems. And so, or even in the developing world, they're putting $5 against 300. So in either case, it's bad, right? And so, so I just think that as we look at opening the pipeline, in the future to make these things more universally accessible, figuring out how we lower the financing cost is probably the single biggest factor about, how big the Venn diagram we can address is. And yeah, and as we discussed, there's a lot of challenges once you start to go into the nits of that.
Barrett, I'm curious. I know you have to run here, but have you seen efficacy in de-risking projects like this and soaking up some of the risk that comes from heterogeneous like solar deployment and emerging market risk generally, either from folks like Allied Climate or IFC or um, other philanthropic bodies or government bodies, or do you think that there's needs to be another pathway there, or perhaps that's not a good lever to pull on?
So the problem I keep running into with this is that there's a certain minimum threshold of interest where it's just the administration cost, right? Like I can't do a 1% loan because I can't administer a loan for 1%. Like just the like collections burden, has an implicit cost. And so I kind of get into this place where what we really need to solve poverty is a lot of low cost debt. Like grants won't get there, but we can't afford expensive capital. And at the same time, it's not particularly financially viable to run 1% debt, right? Like I get why you wouldn't want to do this. It's such a thin margin, high risk thing that it would be tricky. And so I don't know, to me, it's almost like I want a nonprofit bank that like donates the administration cost, right? And so someone, as opposed to like the IFC or World Bank model where they're like, oh, look at like we'll give a low cost loan and that's our charity. It's like, no, no, like donate your staff, right? Do this loan at no cost to us. So we're only paying the return on capital, not the origination fees and, account management and all that kind of long-term cost structure. So that would be what I would dream of, but I understand that there's some like real structural reasons why that's going to be hard because once again, like if you're grant funding the staff, that's not scalable, right? And so they need a clip on the ticket if they're going to be able to grow with demand.
All right, well, Barrett, I'm in for the let's found a nonprofit bank model if you want to have that conversation.
Yeah,
there is one. So I'm donating to a clean energy, what's called Clean Energy Credit Union. It got started out of Colorado. So they take a 501c whatever model to being a bank for financing clean energy, but they operate at a relatively small scale.
Yeah, as do most nonprofit banks I know. But no, hey, it's been a pleasure. Yeah, happy to continue the conversation and thank you as always, Kim.
Yeah, thanks, Barrett. CJ, do you want to share?
Yeah, I'll try. Zoom may not work. Let's just see if it works.
Cool.
Oh no, it doesn't work. Yeah, sorry, I'm gonna have to like system setting, restart, blah blah blah. Let's see. Um, so I dropped a link in from a Vox article about rewiring America from probably like 4 or 5 years ago. If you scroll down about 2/3 of the way down, there is my single favorite explanation of the impact of the cost of financing on projects that and this came no not that it's way down. It looks like it's written with a crayon. There you go. You just passed that one. Yeah. So this was what I came across this when I was selling batteries and everybody's like, "Oh, batteries are too expensive." And this graph pissed me off so much. So uh Saul's arguing that the government should provide essentially infrastructure type loans for energy infrastructure because these assets last 20 years. And so the graph here is to show the cost of the impact of the cost of capital on the project. So every $1 of project cost over time, what is the impact of the cost of capital based on the cost of capital? So you can see if we had 3.5%, 4% like cost of capital over 20 years, $1 in project costs ends up $2. 8%, you can see over 20 years, you have 3.5, almost $4 going to the money for every dollar that goes to the project. And at the time, I was getting like 12%. And I was like, oh my gosh, like you cannot tell me that batteries are expensive if the money is this expensive. So I think this is like, and when you start talking about customers who are higher risk at default, more uncertainty, et cetera, you get higher cost of capital, which just makes the project less like it just makes so many projects unfundable. So anyway, that's my rant.
One question that I had, and again, like speak up if you have other directions that you want to take this in. But one question I have is, and I feel like Tim, you might be a good person to answer this, or anyone here. Like, why doesn't grouping together smaller projects into one bigger project that these like bigger project developers are looking to fund at that level of dollar? Why does that not work? Is it the risk? Is it like where does it fall apart?
It probably should work. in theory. It should create a lower sort of administrative burden for the amount of capital by packaging them together. I think, the effect of similarity of those assets instead of having them be disparate and requiring a ton of diligence on each individual asset would help. Or, this is probably an annoying answer, but that's probably a lot easier to refinance once those projects have run in that package than the first time around, where that, once they've actually run and you've done sort of the project level stuff, now you could roll all those up probably fairly easily once you had some proof of how the numbers actually played out. So I don't know that there's an inherent weakness to that. I think that one of the weaknesses of that competing in the market, where people have referenced looking for the best available asset, is that giant utility scale solar is more attractive equity returns, and then that also makes it easier to lend against in addition, and that attracts a disproportionate amount of all the attention and all the capital.
Yeah.
But I don't think there's anything wrong with that, and probably would be appealing to somebody more mid-size to look at that kind of roll up. But it's always risky to see who's going to go first on too many of those too.
Yeah. And customer acquisition costs, you said, Pete, which makes sense, right? If you're rolling up a bunch of smaller people, projects, communities.
Yeah, so the startup that I've been working on for the last 6 months is essentially this core concept, but on decarbonization opportunities in corporate supply chains. And what we have found is that even if you can get a whole bunch of projects together across a single supply chain, the you either run into there's a divergent I don't know, sorting mechanism here, which is in situations in which you have a relatively sophisticated corporation, that understands what projects they have and understands what they're worth and, can execute on them. They already are relatively far along and don't necessarily need as much help and don't necessarily benefit as much from this de-risking and access to additional capital, um, or lower cost capital. And then the organizations that, for example, don't, have an idea of an ROI of a heat pump or solar on the roof or whatever it is, the project, like getting a spec project is challenging for a lot of different reasons, but a lot of them are just like, you've got to get from someone inside of corporate to a facilities manager. They have to make time for you. You have to explain what the hell you're talking about. That means that like rolling up those things is just practically really expensive, even just from an operations standpoint. Like, how do you actually get the asset or the concept to a place where you can write them all down and roll them up and de-risk them? Like, so that's kind of, yeah. I don't know if that's how I see it mapping, right? Is if you're just doing the same thing with solar, like, yeah, there's a Goldilocks thing. It's hard to find.
Yeah. So someone has to like aggregate all the community solar projects and then talk to each one and then potentially roll it up into something.
Yeah, and particularly like there needs to be some sort of monetization level, either crediting, so we have to figure out monetize the environmental asset piece of it, or and therefore you're tracking stuff and tracking baselines and so on, or alternatively, you're getting them to pay somehow, so it's utility oriented or somehow getting all that the financial side of it is hard.
Yeah. Well, we have 23 minutes left. What direction do people want to go? And I can see a couple others, which is keep asking questions of the group and see where it goes. It could be that we deep dive on someone's problem. So Pete, you have a client, CJ, you have a client, Kevin, you have a company. There might be other people that are like working on things in this space. But I will sit back and hear what you all are thinking. I mean, I guess I was gonna say I'm not talking, but I will. I mean, I think the takeaways that I'm coming across with is like it's a really hard space, and maybe there are like perpendicular solutions where it's maybe not trying to just get the same version of a solar farm to be funded at a smaller level, but to think about different sorts of technologies that can work and that actually provide the value prop at that. Like, I don't know, I'm sort of coming away from this talk being like, what does work, what has worked, and maybe there's a perpendicular sort of way to approach it. I think, Kevin, you kind of are doing that, maybe. Yeah, Pete, what are your thoughts?
I guess I'm curious, like I just am not close enough to this problem
Yeah.
to just be like, what is a replicable structure? Because I guess I just look at this and I'm like, okay, if you were going to decide how you wanted to be most impactful while deploying solar, you would pick places that didn't already have natural gas infrastructure and allow them to jump the infrastructure ladder and straight from whatever coal, whatever, to straight to electricity. That
Yeah.
would be hyper impactful and have all these long-term downstream, like great things, EVs, all this kind of stuff is all downstream. Wonderful. Like, what's the lever that works in that environment where you can say, like, these are repeatable projects? Like, I don't know. And I just like, I was curious if anyone was looking at this and being like, oh, actually, the thing is whatever, charging stations for cell phones in blank, blank, blank. I don't know.
Sounds like no one has an idea. Is the question essentially like who, like what's the trigger for something like this being like being worthwhile to do? Is that essentially what you're saying, Pete? Or maybe reframe it so I can understand it better.
Sure. I guess there are different ways to think about solving this problem. And I guess there are like, I'll start with two, maybe three fundamental, well, I guess there are like two fundamental things,
Yeah.
right? You need to figure out how to source projects, and then you
Mm.
need to figure out how to de-risk them. And the sourcing projects is an open question. I'm not close enough to that world to know. Maybe
Mm.
there's a competitive structure or a prize or something like that, so you could generate deal flow that is organic. I don't know.
Mm.
Lots of interesting ways to solve that problem. And then there's the de-risking piece, and that can happen via heterogeneity. It can happen via increased margin. It can happen with philanthropic players. It can happen with like asset or environmental asset kind of sourcing. Um, I don't know. And so I guess I like think about the problem as falling into those two realms. How do you source projects at scale to do this work? And then how do you de-risk them sufficiently where you can actually scale it. And so I guess like figuring out how to write down those problems and figuring out if any of those pieces of that can be solved in such a significant way that it would generate leverage across the other pieces that also need to get solved. Like if you could come up with $1 billion fund, it's like we'll just de-risk it all. Then you could go out and say, hey, then you have a pot of money to run around with, and that would allow you to source projects and commercial capital and blah blah blah. But I don't know. Maybe there's some really wise way of sourcing heterogeneous projects that allows you to do solves a lot of the other problems.
Yeah, I mean, I like that question of like, is there a problem that is a keystone problem that then unlocks some of the other ones? Yeah, Adam.
Was typing this out, and then I got rid of it. So I'm typically on the pure engineering side of like, hey, we need to put up this transmission, figure it out, connect everybody, blah, blah, blah. And then someone else makes the decision of who actually gets connected because of project cost. So my perspective needs to be critiqued. From the policy side of things, when I was working with people in policy, they are mainly exposed to people and lobbyists that are coming from the finance side. So a lot of the policy is influenced from that perspective. They don't really get a lot of lobbying or feedback from just like the pure engineering side of things, where you're trying to make everything a really well-rounded system or what have you. So um, that's something to consider as well, even when it just comes to the standardization of financing or something like that. Um, and the cost of money thing is something that I think is really worth digging into, because at least even for the people that I know on the solar side of things that are actively working on the development side, whether it's like site issuing or like program management for the actual development of the site and stuff like that, still don't deal with that kind of stuff either. It's mostly like the executive side of the place that is making those kind of decisions. Um, so I feel like a conversation is needed with like some big firms that have recently made really big uh not purchases but like loans with like those high interest rates, and seeing like what do you need to bring down that interest rate, what do you need to see to de-risk this project in your perspective or something like that.
The problem with what do they need to bring down the interest rate is that what they need is somebody else competing with them offering a lower interest rate, right? I mean, they're gonna charge what they think they can get that nobody else is outbidding them for. So, like until they have a competitor, they're going with whatever the market cleared at then. So, to get a wholly for profit lender to say, okay, it was 12 and now it's 10, they're not going to do it to be nice unless somebody else is out there offering 10 and a half. So, traction, proof of numbers, similar projects having come out, that's how you get the market to sort of start competing against one another. There may be too few people offering this kind of finance and not enough competition to bring it down. But it's sort of like, okay, I made the characteristics of the project a little better. You're still not going to get a lender to come down unless they're getting out competed by someone else.
So then, is there a way to, I guess, collaboratively have solar developers or just the greater climate industry work together to somehow increase that competition or increase the appetite for
I mean, more money than ever went into those kind of specific investment efforts than over the last couple of years than ever. Some of that driven by IRA. That's going to drive it over time. But it's still sort of an emerging thing. And there are plenty of people out there trying to raise tons of money to do this still. Tons of private credit could get more involved. You will get more eyeballs on it, likely, as long as it doesn't get slowed down in the US by the current administration. But I mean, you're if you're in a fully economic situation where there's no concessionary capital involved, that's what you're facing. And getting more people involved, people are making money on this. Those newly raised funds are in the black, and that will encourage more capital to flow, and that may sort of drive it over time.
Something called thermal energy networks that New York is starting to do. And it's not, this is like a, different thing entirely, I think. But I thought it was really unique where they essentially, from what I can understand, they have, they can set up like houses and smaller sort of properties and buildings with like a large anchor off taker. And then they can like bring in geothermal, just do things that they wouldn't be able to do on like an individual house level. And I don't know if there's any sort of proxy in the solar space, and maybe it's really obvious, maybe it isn't, but I just learned about this yesterday and thought it was feels somewhat relevant in some way.
Maybe the closest thing, Allie put a link already in the chat. That might be one of the closest things to that, the virtual power plant idea.
Cool, yeah, that makes sense.
Yeah, I noted that because I saw this taking off in Mexico. I read an article the other day, so I wanted to look at it in the US and I thought it was interesting.
All right, so more nonprofit banks.
That was just a joke. I am aware that there are nonprofit banks, alas.
Well, just more. We could have more. But that feels like kind of the ones, and then maybe this virtual power plant thing. Like, are there any other solutions that we've actually talked about here? Just as a summary.
Climatize and some of the others are going, and renewables.org is going in the kind of like Kiva model, which is just basically like, hey, traditional finance isn't excited about doing this because they see all the risk and opportunity costs and blah blah blah. So we'll just go direct to consumer. Wonder did this a long time ago, whatever. I think that probably still works. I don't know that you end up in the billions or trillions of dollars range, which again, probably the goal.
I was trying to figure. I didn't interject what I was thinking a little while ago when the question came up because I'm fairly pessimistic about the idea of actually in today's conditions being able to streamline and bundle this and make it efficient. And then I remembered that Candace, I actually made an intro to you for somebody who, or somebody you already know, but I think like we actually need a policy change because we have 3,000 utilities, all with their own rate programs, all with their own rate structures. It's super inefficient and impractical to scale across all of those effectively. And even VPPs have like, there's no standard, there's no even definition of what it is. There's no standard valuation of the value they provide to the grid. And every regulator is coming up with its own program. And so I had suggested actually that Ted Koh come and talk to us about kind of like the policy, like creating a level policy framework that we could advocate for across the industry so that we actually have something to say like, okay, great. Instead of every understaffed, under-resourced regulator going out and trying to create some program that would do this, like let's start to create some standard definitions, some standard program designs, some standard valuations or ways of calculating value to the grid, and then start like rolling those out in mass. Because I think that would actually create better mechanisms for us to get things financed because every market and every ISO and every utility like just creates a different structure, which just makes it way harder to scale.
Good reminder, he's on my to-do list to reach out to, but this is, yeah. The question of like local versus, higher level regulation too right now, I think is a big one on my mind, right? Do we go for like the big ones or do we just try to stay local given Trump?
Well, one of the issues though, and somebody had I think it was maybe one of the Volts podcasts recently, is just that like the only way to meet the increased capacity in the next 2 to 3 years that's being demanded by, largely like, server farms that are wanting to come online is with DERs. Like you have to leverage what's already installed. And so adding a software layer on top of that is literally the only way the infrastructure can adapt fast enough to enable more growth. Longer term, there's more options, but in the short term, it's literally the only thing that can be done.
Yeah. Cool. Okay. Well, I feel like we got a lot done and also nothing done because it's sort of like just like understanding the space and understanding how complex it is. This is the first member-led event that I've led, and I'm like, I should never do this again. We actually need someone who knows what they're talking about in the topic. So, but hopefully you guys got something out of it. And I guess if I'll try to do a summary, and then we can wrap up. And if there are like next steps or just like next topic areas that you'd want to dig into, happy to sort of think about that. But problems, going back to that, right? Like bad credit scores, risk, value prop for lower income people, and then just economies of scale, right? And there have been a lot of different ways to try to attack this. There's tax credits, there's blended finance, or sometimes the smaller funders get screwed by the bigger capital financiers. There's debt financing in the space, but again, that sort of economies of scale, I think, gets in the way. Did we talk about renewable energy credits as much? I think we touched on that as well. Happy to revisit that. Nonprofit bank, there's a lot of energy there. And then that sort of grouping together of projects maybe works in theory, but is actually a lot harder to accomplish in reality. And then there are a bunch of different companies trying to do something, right? So Climatize has like the Kiva model, there's the VPP model that I think Ali, you shared. There's, I don't know, probably a few others, but there's probably more to talk about on the policy side as well. Anybody else have any like final summary things and or any other things that you want to share before we close out? And again, next steps if we want to go deeper.
I do also just want to put a plug into anybody actually looking for money for projects to check out the Greenhouse Gas Reduction Fund money. There's like I don't know, a bazillion dollars. I think it's 100 billion. It's a very large number. It's distributed through a number of different entities, and it all is going to get deployed within 12 months, starting like any day now. They're looking for projects ready to go. It's kind of concessionary capital.
Yeah.
It should not be clawbackable by the current administration because the money's already out of the federal government.
Cool. And then maybe bringing in a green bank who then gives like a I think Elemental Impact has some of that money, right, CJ? But then green banks have some of it as well. And so maybe someone on that side would be good to bring in.
Yeah.
Does anybody know anyone at a green bank that you really respect and think could do this? Otherwise, I'll do some research, but I think it's a good next step.
The folks at Banyan are basically the system of record for the green banks using
Cool.
distributing GGRF who are using that. So they probably could make a connection to a green bank if you want a green bank. Elemental is like doing the role of some of the green banks also with their pot of that money.
So Banyan Infrastructure, you think would be they'd be good to bring in?
Or to connect you, if you want a bank,
Oh, got it.
To connect you to a bank because they work like a bunch of them.
Cool. Okay. Any last comments?
This was really fun. Thank you, Candace.
Of course.
I'm kind of unsurprised that we were able to crack this one first go, but I'm not dismayed. I think this is good.
Yeah, you're right. Hard problem.
It's now starting all my research again. Like, it's a lot of great insights, and I'm also questioning on the models in Europe. Potentially, it could be reapplied. It's a bit farther ahead.
Well, so you know that Kevin's doing something with like a European model to the US, right? And so I think that's really smart. Anything that you guys learned, just share in Climate Vine in the discussion or whatever, because that would be interesting. And then Adam, do you want to close this out?
Dimitri probably has a good contact for Green Bank.
Yeah, that's a good point too. All right. Thanks, everyone. We'll see you.
Hey, Candace, sorry, I was a little bit busy, but I'm happy to ask the Clean Energy Credit Union.
Oh, yeah.
Their members to come and give a talk.
I would love that. Cool. Thanks, Kevin. All right. Bye, everyone.